Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, our weekly look at the world of business and finance. This week, Portugal. Widely seen as the next stop on the Eurozone bailout tour, but not so, says this man. He's the Prime Minister of Portugal, and he's speaking exclusively to Counting the Cost. And who's in town? The other big economic story of the week saw the leader of the world's rising power meet the leader of the world's biggest economy. But has China got the United States worried? So a slightly different Counting the Cost this week. We're looking at just two stories, one in Europe and one in America. Now, the Europe one is really about just one country, but it starts wider than that. Because once again, we've had the Eurozone finance ministers meeting in Brussels, their first meet of the year, and once again, they've failed to agree on increasing the Eurozone's emergency rescue fund. Rewind to May of 2010, and for a change, we're going to talk exclusively in euros rather than dollars. A 440 billion euro fund was set up to save debt-ridden nations, but not all of it could be used. Some had to stay in place so the fund could maintain a high credit rating. So in effect, it was down to 250 billion euros, which many economists feel isn't enough should both Portugal and Spain require bailouts at some point. The bond markets, though, they've been pretty relaxed over the last 2 weeks, partly because the European Central Bank stepped in and bought up 77 billion euros worth of bonds, but also because Russia, China and Japan have said they are willing to buy Eurozone bonds. Which is frankly what a country like Portugal needs to hear, under so much pressure to dip into that bailout fund, if not take a good swim in it, but managing to keep the wolves at bay through a successful bond auction. The thing is, many are still unconvinced about Portugal's financial state. Why? Well, the interest rate, first of all. Portugal pays close to 7% on its bonds, and anything over that would likely put too much stress on the economy and its ability to pay interest on those debts. Portugal, though, says if it was to borrow at 7% for the rest of the year or above, its average interest rate on all its debt would be just 3.6%, and that's totally doable. Bottom line, though, is Portugal needs to raise another 20 billion euros this year, and that's a lot of borrowing in an age of austerity. And so to our feature this week, an exclusive interview with Portugal's Prime Minister, Jose Socrates. He was here in Doha, boosting political and economic ties with Qatar. Probably a welcome break for him, given all the doubts over his economy back home. It has not been an easy time to be the Prime Minister of Portugal.
No.
If I can make a huge general statement like that. What's it been like for you personally?
It's not good times for governance, not in Portugal, not everywhere else in developed countries. It's not a good time for Europe. But I think we are facing a situation that is a consequence from the crisis in 2008. And to be objective, I think Europe has done very well facing that crisis. We stabilized our financial system. We have done very well to face the economic crisis in 2009, and we are recovering now. And
really?
British.
I'm going to interrupt because I noticed you called it the financial crisis of 2008. This isn't over. This is still going on, and some would say it's even getting worse.
We are facing the second part of the crisis, the so-called sovereign debt crisis. But listen, now in 2010, Europe is growing, not declining in terms of economic growth. So it's another situation, and we are dealing now with the problem of our public finances, not only in Portugal but also in Spain, UK and other countries that were forced to spend more in order to stabilize their economies and to help the financial system. And I'm pretty sure that in 2011 the figures we have now are give me quite good confidence to tell you that we will overcome this situation. For instance, in Portugal, in 2010, first of all, we decided to reduce our public deficit 2 points. We will reduce more than 2 points. This is a very good achievement for an economy that feels the need to put in good shape our public finances. It's a very good result of our effort. The second, at the same time we reduce the public deficit, we will grow more than 1.4%. This is two big figures of our national economy that give us confidence to face the challenges.
And yet everyone says you still need a bailout, like Greece did and like Ireland. And I'm going to quote you. One moment, I'm going to quote you. This is 2 or 3 days ago. You said, "We are able to do our work by ourselves. We don't need anything else than confidence." That is a very, very confident standpoint when, if I make a great big generalization again, everyone seems to say you need a bailout or will need one.
Well, sometimes everybody is wrong because we don't need that help. We don't need any kind of external assistance. We know exactly what we should do and we will do it. You know, this is the second time I will do it. Because in 2005, Portugal had, when I became Prime Minister, we faced the first crisis in our public deficit. And we reduced our public deficit from 2005 to 2007, from 6.8 to 2.6. And after that comes the international crisis. So I have done it before and I will do it again. I know exactly what to do, and we don't need any kind of help but confidence in our government policy, but also in the economy.
So do you understand then why other countries think you do, though? Because you're painting a very, very positive picture. Do you understand why other countries don't feel as
other countries? I don't know.
Or analysts or in the markets. I mean,
yes, but as you probably saw during the last 3 years, the analysts can be wrong. And they were wrong in 2008 regarding some issues in the past, but they are wrong in the analysis of the European economy.
Do you think it's almost become a case of people, and I'm talking analysts, markets, whoever you want to say, picking off countries one by one? First it was Greece, now it was Ireland, now it must be Portugal that needs it next, or it must be Spain that needs it next.
Europe took some time to understand that this is a systemic crisis, a systemic attack, a speculation attack against euro. Well, I don't think the markets have in its nature to speculate. Of course, they want to win money. That's their job. But I think they are not seeing the real situation. The attack to the euro is very unjustified. The economy in Europe is growing, and all the countries in Europe know exactly what they should do in order to restore confidence. It's the first time that Europe is facing a situation like this, and because for the last 80 years this situation never occurs. The suspicion of the markets of the capacity of the European economies to pay their debts in the future. But I'm pretty confident that the measures we take at European level and the measures each country is taking to reduce their deficits will restore confidence.
What it's given rise to, though, is this idea of contagion, the idea of the disease spreading, if you like. Now, I spoke to the Deputy Foreign Minister of Spain very recently, and I asked him, do you worry about what's happening next door in Portugal? I wonder if you worry about what's happening next door in Spain, because they've got terrible problems. They've got huge unemployment, much bigger unemployment problems than you do.
Yes, I'm worried. And I'm worried what is going on in France, in Italy, in the United Kingdom, and in Germany. I'm worried with the European Union. The European Union is a very important and critical project, not only for the Europeans, but for the world. And we are facing now a crisis that, as you know, it came from the United States and it's not a problem of states. The problem was the absence of the state in the regulation of the financial system in 2008. Please, it's very important not to make a confusion. The origin of this crisis was the markets, the bad functions, bad behaviors of the markets, not of the states. The states answer to the situation, spending money to stabilize the financial sector and also to recover our economies. That's why our public deficits went up. But now we are making the correction, and I think the world knows exactly that Europe can do their job properly.
Forgive me interrupting you. Has it lived up to those expectations? What you see now, the Eurozone that you see now, where smaller countries have almost ended up bringing down the bigger ones. They've needed bailouts from the bigger ones. I mean, is that what you imagined?
No, of course. I never imagined to have a crisis like this. It's the crisis of a lifetime.
But has it reacted how it should have?
All of the states made mistakes to face the crisis that they never lived. Listen, during your life and during my life, we never had a crisis like this. It was, for some reason, the biggest crisis since the Great Depression in the 29 and 30 of the last century. All the politicians make mistakes where they're facing new situations. But I think we have done what we should do in order to control the financial system in 2009, in order to give more money to our economies, in order to restore confidence in on enterprise, in families, to help families, of course, to resist better to the crisis. And now we have the burden of the excessive deficits. But we will face and we will overcome the second phase of the crisis. I'm pretty confident on Europe.
You are?
You know, it's a lifetime project, and we will not give up only because we have a crisis. The crisis sometimes are inspired to go further. And the answer to this crisis show me that it's necessary not less Europe, but more Europe. This is the correct answer to this crisis.
Just a few final thoughts from you. You were re-elected, correct me if I'm wrong, September of 2009. So that was right in the middle of when things were bad.
Yeah.
Now,
when things are bad, and I never dreamed that we will have another phase of the crisis of the sovereign.
Well, you saw your majority went down a lot in that election, but you still got re-elected. What do you think it was? At a time when leaders were falling because of economic crises, what was it that kept you in power, do you think?
Well, I think the Portuguese understand that in that time we are facing and we are doing exactly what we should do to face the crisis. I think that
so they understand austerity, because a lot of the rest of the European public, they understand austerity, I'm sure, but they sure don't like it.
They don't like the austerity. No one likes austerity. But I'm pretty confident that the Portuguese people understand this is the right track to address the situation and to become again a country with economic growth. As you said, in that time, September 2009, I ran for elections in a very difficult period of time. And we only liked the victories, difficult victories, and that was a difficult victory. I'm very proud of that.
Do you worry about what all this has done to your political standing?
No. In these moments, a politician should be concentrated to serve his country. On my spirit, there are only one preoccupation: to serve my country, do what is necessary to overcome this situation. And I will do it. And I understand the austerity measures can be very unpopular. And when a politician decided, like I decided for the next year, to cut salaries, to freeze pensions, to cut some social benefits, to raise taxes, this is the perfect storm for a politician. But I'm pretty confident, and all the Portuguese understand that I am doing this because we have no alternative, and we must show the world that we will do what is necessary to overcome. We don't need any kind of external assistance than confidence. And this is the most important. In these moments, in these critical moments, the only preoccupation a politician should have in his spirit is to serve his country the better he can.
Prime Minister, it's been a pleasure talking to you. Thank you for your time.
Thank you, and thanks for the opportunity.
And now to our other big story, the much vaunted visit by China's President Hu Jintao to the United States. And here's a quote for you. "We want to sell you all kinds of stuff. We want to sell you planes, we want to sell you cars, we want to sell you software." Who said that? Actually, not who. Barack said that, perhaps one of the lighter moments in an otherwise uneasy news conference between the US and Chinese leaders, underlined when Obama accused China of deliberately devaluing its currency and giving it an unfair advantage. Have a listen.
I told President Hu that we welcome China's increasing the flexibility of its currency, but I also had to say that the RMB remains undervalued, that there needs to be further adjustment in the exchange rate, and that this can be a powerful tool for China boosting domestic demand and lessening the inflationary pressures in their economy. So we'll continue to look for the value of China's currency to be increasingly driven by the market, which will help ensure that no nation has an undue economic advantage.
So, as the theory goes, you devalue your currency, your exports become cheaper, which means jobs created in one country, but jobs lost in another. Just part of the tense economic ties between the US and China. For 11 months last year, the US trade deficit with China, it was $252 billion. Break it down, though, the US exported $82 billion worth to China over the year. China sent back goods and services worth $300 billion. It is a huge, huge imbalance. Also a matter of concern for the United States is China's rising military power. Even though the US is still way out on top, its 2010 spend on defense was $722 billion. Or to put it another way, more than 40% of the world's total military spending. China spent a tenth of that, about $78 billion. But they are certainly arming up and seemingly have that new stealth fighter too. But still, currency is the big issue. Now, China argues the weakness of the yuan, or the renminbi as it's also known, is not the reason for the United States' economic malaise. President Hu himself, before he left for Washington, he called the dollar a product of the past. Now, that's seen by many market watchers as Beijing's continued move to internationalise its own currency. Rob McBride has more on that from Hong Kong.
At a major conference in Hong Kong this week, it's been the talk of the international financiers. The rise and rise of China's currency, the yuan or renminbi, matching China's own global march towards economic dominance.
Growth of the offshore renminbi market is very important in that context, as more companies seek out products which are renminbi denominated, and I think this is where there is a terrific opportunity here for Hong Kong.
Hong Kong has become China's testbed for how to internationalize its currency. Renminbi deposits in the banks have surged into the billions in just a few years. Local residents are able to buy the equivalent of $3,000 daily, and many have been hoarding cash as a hedge. Many high street stores are happy to take renminbi from the hordes of mainland tourists passing through here. McDonald's recently issued a renminbi bond to fund further expansion on the mainland, and the city's local stock market is expecting its first listing in renminbi later this year. With Hong Kong's background firmly rooted in trade, especially with the West, the value of the local currency, the Hong Kong dollar, has for decades been pegged to the US dollar. But given the rise of the renminbi, many people here are asking why. Just as many are now asking whether globally China's currency might take over from the greenback as the world's preferred reserve currency.
Pretty much depends on how the government opening up. I think it's got to be a balanced, gradual process, because the issue the government facing is if you suddenly opening it up, imagine the market volatilities, suddenly there's a big collapse.
And Hong Kong, for now, is staying loyal to the dollar.
The criteria for choosing a currency anchor is that it has to be fully convertible. I'm afraid the renminbi, however enthusiastic I've been talking about it so far, is still a long, long way from that.
Given the staggering speed of China's growth, No one is betting just how long before Hong Kong, like other parts of the world, may be looking for a dollar alternative.
All right, let's talk more about this with Rajiv Biswas. He is Asia-Pacific Chief Economist at IHS Global Insight in Singapore. Rajiv, this is apparently the most important visit by a Chinese leader to Washington in 3 decades. Is there any risk of overstatement here?
Well, I think, we're now seeing the heads of state of the 2 largest economies in the world meeting, and this is a very important dialogue to set a positive agenda for the future between these 2 great nations. Particularly on the economic side, it's clear that the Chinese have brought significant new orders for the U.S. And at a time when the U.S. economy is looking for momentum, looking for boosting exports, this is very important in terms of the economic outlook for the U.S. So I think President Obama has given this a very high importance from an economic perspective as well. We had announcements of about $45 billion US dollars of new orders from China signed in this visit. So of course this is a big boost for US exports as well. So from that perspective, I think this is a very important commercial exchange for the long term, and in 10 years' time, China's going to be the world's biggest economy. So the U.S. also has to have that perspective that this is the most important export market for the future for the U.S.
And it's absolutely intriguing watching them, isn't it? I've heard them described as frenemies, friends, enemies at the same time. 2 countries with so much to give each other, but still so much niggle, especially over this currency issue.
I think that, of course, the currency issue keeps coming up, but I think, although there's a case to argue that the renminbi's undervalued and needs to appreciate, I think this is not the crux of the issue in terms of adjustment of the trade gap between the U.S. and China. I think the key is that Chinese consumption is still a relatively low share of GDP, only about 1/3 of GDP, and it's about to start increasing. I think we've seen a trough in that, and as per capita incomes in households in China are rising over the next decade, I think we're going to see consumer spending as a share of total spending rising, and I think this is going to make consumer spending in China an important growth area, and creating new opportunities for U.S. exports into the Chinese economy. So I think the trade gap will start to gradually adjust over time. It's not going to happen overnight. So I think that, the debate about the currency, undervaluation, I think this is only a very small part of the overall picture about how the trade gap's going to adjust between the U.S. and China over the next decade.
Okay, so if the one isn't the biggest issue, then what about the flip side, the dollar itself? Because Hu Jintao has said the dominance of the dollar is waning. Anecdotally, yeah, maybe it is. Economically, do you think that is the case?
Well, I think clearly the U.S. dollar is still the world's largest and most important reserve currency, and that role will gradually shift, but only very gradually. And I think we have to recognize that as China becomes the world's largest economy, and we're seeing a gradual process of increasing yuan convertibility in very gradual steps, but it's happening, that also the Chinese currency will play an increasing role as a reserve currency. Of course, until you have full convertibility of the renminbi, you're not going to get there. But I think we are seeing already announcements by the Chinese government and by the central bank that are indicating quite a clear time frame in terms of the steps towards that yuan convertibility coming down the road. So I think it's China's currency that's going to play an increasingly important role as an international reserve currency. But I think for the foreseeable future, the US dollar will continue to be by far the most important reserve currency globally.
And that is about it. Don't forget to get in touch, though. Twitter's been very active in the last few weeks. At AJ Counting Costs is where you find us. We put pointers to next week's show there, plus happily take your questions and suggestions. You can also head to our website, click the business tab at aljazeera.net/English, follow the links to the Counting the Cost page. On this week's entry, there at the bottom, you'll find a special video uploaded about Apple's fourth quarter profit numbers and the Apple brand as a whole. It features me with a giant iPad. So if you like your gadgets, it is well worth a watch. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.